let's jump right in. Have you ever wondered what happens to a massive multi-billion-dollar ski corporation when Mother Nature just completely refuses to cooperate? I mean, it's the ultimate stress test, right? When your entire business model depends on the weather. Welcome to today's Explainer, where we're going to unpack exactly how a corporate behemoth survives a historically dry winter without, well, completely melting down. So, to figure this out, we're diving into a really fascinating case study, Vail Resorts. Specifically, we're looking at their third quarter earnings report for fiscal 2026. And let me tell you, this document, it's an absolute masterclass in risk mitigation. It gives us this amazing front row seat into the mechanics of corporate resilience when they're facing a totally uncontrollable crisis. We're calling this analysis the shock absorber, because that's exactly what we're decoding today. The literal mechanisms Vail Resorts uses to just cushion the blow of a terrible ski season. Honestly, if you want to understand how a modern business shifts risk around, this is your perfect blueprint. Here's our roadmap for today. Number 1, the weather challenge. Number 2, the Q3 financial impact. Number 3, the season pass shield. Number 4, cost control strategies. And finally, number 5, looking ahead. Okay, section 1, the weather challenge, a historically bad winter in the West. So to really set the stage here, we got to talk about the one uncontrollable variable that kicked this whole test into motion, Mother Nature. For the ski industry, no snow literally means no product. And Vail CEO Rob Katz didn't mince words about this in the earnings release. He flat out called it one of the most challenging winters in history across the western U.S. We aren't talking about a slight dip in snowfall here. This was a severe anomaly that absolutely battered their massive destination resorts in places like the Rockies and Tahoe. Decades ago, a systemic shock like this, it probably would have bankrupted a smaller regional mountain operator. Moving on to Section 2, Q3 Financial Impact, measuring the dent in the armor. Now let's look at the actual math, because you can see a very clear, very significant drop. Net income fell from $389.7 million in Q3 of the prior year, right down to $314.4 million in Q3 of 2026. That is a highly noticeable chunk of profit, just totally wiped out by the dry skies. But to really wrap your head around the scale of these missing crowds, you've got to consider this stark metric, 15%. Total skier visitation plummeted by 15%. That's a drop from 8.6 million visits all the way down to 7.2 million. Just imagine walking around your favorite resort and realizing that nearly 1 out of every 6 skiers is just entirely missing. And naturally, missing skiers means missing dollars. Resort net revenue decreased by $90.4 million. That's a 7% drop. And resort reported EBITDA, which if you're not a finance nerd is basically just the core profitability of their mountain operations, that took a direct hit of $61.3 million, or nearly 10%. Because think about it, when fewer people show up, fewer people are buying those expensive mountain cheeseburgers, right? Fewer ski rentals, fewer hotel bookings. The ripple effect is huge and the damage is very real. Which brings us to Section 3, the season pass shield, the advanced commitment model. Okay, a 15% drop in customers could easily trigger a 30 or even 40% drop in profit for a business that relies on massive fixed costs. Running ski lifts is not cheap. So, how did they avoid a total disaster? Well, before we talk about how Pass has saved them this year, we actually have to acknowledge the hangover effect. Because the weather was so bad, early spring demand for next season's passes definitely softened. Pass product unit sales for the upcoming 2026 and 2027 season, they're down about 10%. And it makes perfect sense. People in weather-impacted markets like Colorado, Utah, and Tahoe just delayed buying their passes. You can't really blame them. But take a step back. Why do early pass sales even exist in the first place? It's all about the advanced commitment model, and honestly, this is a brilliant strategic shift. By selling non-refundable passes months before the first snowflake even has a chance to fall, the resort is basically taking the weather risk off their own balance sheet and handing it directly to the consumer. This is exactly why your inbox gets absolutely flooded with discounted Epic Pass emails every single May. It locks in the company's revenue, completely regardless of what the clouds decide to do in January. And this brings us to the ultimate aha moment of this whole explainer. Check out this dynamic. We already established that visitation dropped by 15%, right? But lift revenue, that only declined by 5%. Now, how is that mathematically possible? Well, it's because 2025 and 2026 North American pass sales had actually increased by 3% heading into the season. The money was literally already in the bank. The skiers didn't show up, but their dollars had already arrived. It's kind of genius. Now, what's also super interesting here is how geographic diversification adds this whole other layer of armor. While North America was struggling, there were actually massive bright spots globally. Epic Australia Pass sales saw a booming 26% jump in units and a 31% increase in sales dollars. When you own mountains in different hemispheres, summer in a struggling North America is winter in a booming Australia. Talk about a hedge. All right, let's jump to Section 4, Cost Control Strategies. Aggressive internal management. So, beyond just geographic diversity and pre-selling passes, you've got to manage your expenses. When revenue drops, aggressive internal cost controls are pretty much your last line of defense. As CEO Rob Katz pointed out, strong cost discipline kept us on track to exceed our resource efficiency transformation plan savings for the year. This perfectly proves a fundamental rule of business. When external conditions fail you, like, the weather, you have to lean incredibly heavily on what you can actually control internally. And they didn't just meet their cost-saving goals, they flat out exceeded them. They are now expecting $106 million in annualized cost efficiencies. To put that into perspective, that's actually $6 million higher than their original 2-year plan. They essentially used the crisis to trim the fat faster and way more aggressively than they initially projected. So what does all this defensive maneuvering actually achieve? In a word, stability. Despite one of the worst winters in Western U.S. history, Vail Resorts maintained a massive $1.1 billion in total liquidity. I mean, wow. And their net debt? It remains at a highly manageable 3.5 times their trailing EBITDA. They took a heavy punch, no doubt about it, but their feet are planted firmly on the ground. Which brings us to Section 5, Looking Ahead, Revised Guidance and Capital Plans. So how does a resilient, but let's face it, pretty battered quarter shape the rest of their year? Well, because of those severe weather headwinds, they did have to officially lower their full-year guidance. They're now expecting net income to land somewhere between $128 million and $162 million, with resort reported EBITDA settling between $735 million and $755 million. Yes, it's absolutely a downgrade, but think of it as a controlled descent, definitely not a crash. What's really critical to take away from this is their unwavering confidence in the long-term model. As management pointed out, historical U.S. ski market data suggests that visitation almost always fully recovers the year following a poor weather season, provided the snow actually returns, of course. And because of this historical trend, they are not retreating one bit. They reaffirmed a massive capital plan of up to $239 million. They're aggressively investing in new lifts, much better snowmaking, new technology, and further growth in Europe. They are betting big that the snow, and more importantly the skiers, will definitely return. Which brings us to our final thought. The advanced commitment model completely saved Vail Resorts this year, heavily relying on passes sold before that terrible winter even started. But what happens next? Are average skiers going to just forget the dry slopes of this past year and eagerly buy their passes again in the fall, trusting those historical averages? Or will the psychological burn of a green winter permanently chill demand, potentially cracking the very shield that protected the company this year? It is such a fascinating question of consumer psychology completely colliding with climate realities. Thanks so much for joining us for this explainer, and we'll see you next time.